Right now, these gold's about to become front month. It's 1870. We've got some numbers in the 19 teens and the mid 1920s that say it's over, going right back up again. Well, watch the next week or two in bonds and gold. If we start to see recovery, no, not gold. Gold, I have to go back to 2050 or anything like that. But a couple points in bonds, 20, 30, 40 bucks in gold. This process of attempted breakage in gold is over with. You had your chance last year to break it. You broke it. Okay, didn't go anywhere. Remember that. Okay. So any hiccup back to the upside now, I think gold's going to reassert itself. And the top of that box you see on price, gone.
Gold slipped as the dollar rallied and bond yields gained amid speculation that central banks will keep interest rates elevated for longer to rein in inflation. MichaelOliver is a prominent figure in financial analysis, specifically known for his expertise in momentum structural analysis. In this video, MichaelOliver explains that recent pressure on gold and silver could be temporary, contingent on potential improvements in the bond market. MichaelOliver believes that despite downward pressure, silver has yet to breach its previous lows. Silver is expected to trade at $22.65 by the end of this quarter, according to Trading Economics global macro models and analysts' expectations. The silver market was undersupplied by 237.7 million ounces in 2022, according to the Silver Institute, and deficits are set to continue in the years to come. However, huge above-ground stocks and quantities of metal held by individuals and investors fill the gap. MichaelOliver predicts a potential significant price breakout for gold if it regains strength. The latest Kitco News weekly gold survey sees most market analysts optimistic that gold will see a bounce in the near term, while retail investors are more evenly divided after experiencing 7 straight sessions of losses. MichaelOliver suggests that for bearish traders in gold and silver, this might be their last opportunity to capitalize on the recent sell-off. Now, we are presenting the clips of MichaelOliver's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Silver is interesting in that now it may break those lows, but as gold has come down from its highs above 2000 early this year, it made a low above 1900, rallied back up in the high 1900s. It came down, made a slightly lower a couple months ago than that prior low. So zig, zig, zig. This time it flushed out both those two prior lows, a downward zigzag. It's like been 3 waves. By the way, 3 waves is quite conspicuous. That third wave better be a disaster, because if it isn't, that's all you get. Okay. So it's had 3 probes lower. Silver hasn't done that. Yes, silver's under pressure, but silver right now is around 2250 last I saw. Its prior 2 lows of the last several months are down closer to 22. So despite the pressure in silver, it hasn't managed to take out its prior 2 lows, corrective lows. Of course, its low back in February was under 20. It was a very sharp drop. It dropped from like 25 under 20. But since then, it popped up to 25, 26, and has had repeated sell-offs that are redundant. In other words, it's the same price levels you saw a couple months before. So it's really not trending down. It's trending sideways in broad swings. Right now, it's in a downswing. So I would say to bears in gold and silver, you better make something really good out of this sell-off, because if you don't, this is your last one. As far as numbers on silver, I would suggest a back up around today's highs on a weekly close around 2350. Should get your attention, indicate that the recent pressure is over, and especially above 2450 anytime in the next quarter. That those are indications that any lid you think there is on silver is going to come out. In the case of gold, I think the numbers are in the low to mid 1900s. If you thought this recent drop was the one that would kill it, then this is your last chance, bears. And if you get back up into low to mid 1900s again, your chance is blown. Gold's going to reassert itself back toward what could be a quadruple top price breakout. That will wake up the ever bears. They'll say, "Oh my gosh, yeah." And so, but momentum will speak before that, well before ever getting back to 2070 again. But anyway, I think that's right now we're looking at one of these situations where the panic in the bond market has also been in sync with the recent pullback in gold, not collapse. And then when the bond market turns up, and we're already seeing evidence of that now, and we've got some numbers that go into effect next month, new quarter, new month, momentum numbers, Now, you get TLT, for example, which is a very active 20-year plus T-bond ETF. A couple points above where it is right now, it's starting to break out via some momentum metrics, not the price chart. But I think that could create what you might call a V bottom in the T-bonds. No, it's not going to be a sustainable rally in the bonds, meaning if yields start dropping, it's just a counter trend rally in bonds and a contrary drop in yields. It's not going to sustain, but it could be impressive. And I think during that process, that's when gold's going to get a breath of air and be in sync with the upturn in the T-bonds this time. And except different. Gold will be far more dynamic.
MichaelOliver delves into the correlation between the recent collapse in the Treasury bond market and its impact on gold. Gold and silver prices are solidly lower in midday U.S. trading Wednesday, with December gold futures notching a 6.5-month low and dropping below psychological support at $1,900. An uptrending U.S. dollar index that hit a 10-month high overnight and a 10-year U.S. Treasury note yield that scored a 16-year high this week are bearish outside market elements for the two precious metals. Furthermore, MichaelOliver predicts a rebound in Treasury bonds, which could raise concerns among major financial institutions regarding their limited control over the long end of the bond market. Let's get back to the interview.
Now, we happen to think, and this is not always true, by the way, this correlation, that the recent collapse in the T-bond market, and it was a collapse, okay, it was a crash-like event. We pre-called it a nuke event, okay, that would cause a major one. It's in coincidence with gold now. It's trending with gold. In other words, as bonds went down in price since basically a high in April. Okay, gold started down from a high monthly close in March and April, just below 2,000, and bonds collapsed. Gold didn't collapse. Gold is eroded down. Well, we closed 1999 at the peak monthly close, so we're 7% lower. Okay. Bonds have collapsed. Now, I think when the bonds turn up, and I think they will, and there's not. Part of the reason for that is that the Fed doesn't really control the long end of the market. They control the short-term stuff and they have their balance sheet. But when the long end of the market collapses like it has and rates shoot up, I recall very vividly that last year, prior to the October low in T-bonds or the high in yields, it was a very sharp drop. We got bearish in late 2020 and bonds collapsed and collapsed and collapsed. And last October, they made a pivotal low that we predefined as a bounce point. But just prior to that low, during that process of collapse, Yellen was panicked. She expressed herself at numerous interviews and so forth that she was very concerned about the, quote, illiquidity in the bond market. She has not opened her mouth during this recent crash. Nobody from the Fed has expressed fear or concern about it, and they know they should because you literally have crashed the bond market. If you look at a price chart of gold daily and a price chart of T-bonds, you'll see the bond market's gapping down, much like some wild commodity, okay? And gold has been eroding down over that same period of time since March, April, in sync with bonds. Now, I think the reason that we're in sync with the bonds this time around is that when there's a perception out there, especially among major asset managers, the Fed has gone too far. This event in the bond market is not something the Fed wanted or Treasury wanted at all. It is evidence that they're not in control. They may control the short end and be incremental and so forth, but that front end, that long end has crashed. It will have consequences. This is the biggest market in the world from their perspective, the one that must be defended. And when it crashes like it recently has, it no doubt has caused much concern among major banks.
This week, 13 Wall Street analysts participated in the Kitco News Gold Survey. 7 experts, or 54%, expected to see higher gold prices next week, while 4 analysts, or 31%, predicted a drop in price. Only 2 analysts, or 15%, were neutral on gold for the coming week. Gold and silver face uncertainty due to rising Treasury yields, while safe haven interest remains subdued. This month, prices for gold markets continue to show bearish signals and a lack of bullish momentum. Earlier last month, gold prices began to breach support zones, indicating a future downtrend continuation. The market would need to see a bullish reversal with volume to establish buyer strength. How do you see the precious metals market evolving in the coming weeks? Share your thoughts in the comment section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.